Hello there. Let's solve a February-March 2022 paper 1-2. I found this online. It's not official, and that's why it looks like that. It's not an official release, so it will not exactly look like the real paper, but according to people online, they say this is the exam. This is what they got in February-March 2022. Okay, so let's begin. What is, and by the way, share this with your friends. I think tomorrow on 16th of May, a lot of people have their exams. So it will be very useful to your friends if they study accounting. Make sure you share this with them too. What is prepared by a bookkeeper? A bookkeeper does the day-to-day tasks, right? Maintaining the day-to-day transactions in the account in the accounting books. Appropriation account, cash book, income statement, statement of financial position. So it has to be cash book because that is something that's maintained on a daily basis. It's a book of prime entry. Appropriation account, income statement, statement of financial position, all these things happen at the year end. They involve profit, and that's the job of an accountant. An accountant prepares financial statements. Simple. Which item is an asset? An amount owing by credit customer. When customers owe you, that is your asset. That's called trade receivables, right? Trade receivables are the assets. A is the answer. Let's move on. Number 3, Fatima required additional finance for her business and borrowed funds from Ali. Fatima borrowed some money from Ali. This was deposited into the business bank account. How should Fatima record this? Okay, so basically Fatima took some loan from Ali, and of course it went into bank, so bank is debited, that's for sure. And Ali loan account will be credit. You know why? Because we're taking a loan from Ali. We borrowed funds. We didn't purchase goods on credit from Ali. It's not trade payable. Trade payable has a very specific meaning. Trade payable means when you purchase goods, and that is a payable. Number 4, on 1st March, a business owed its suppliers 9,500. During March, the following transactions took place. How much did the business owe its suppliers on 31st March? Okay, so in the beginning, amount owing is the 9,500. Further goods were purchased on credit, so this will be further payable. That will increase the payables. Goods returned to suppliers, that will decrease the payables. Checks paid to suppliers, that will also decrease your payables, right? There's no way that your liability will increase if you're paying the money. It's going to fall. Cash discount received, your liability will fall. So it starts with, I'll just grab my calculator and do my calculations. It starts with 9,500 plus 10,000 minus 200 minus 8,900 minus 100 gives me 10,300. Should be the right answer. Let's move on. Number 5. Which document from a supplier reduces the amount owed by a customer? Which document from a supplier reduces the amount owed by a customer? That's reduction in invoice. Customer owes you something, but then you issue a document which now tells them you don't have to pay the full amount, you have to pay a lower amount. That's the credit note, right? Credit note is when a supplier allows a reduction in invoice. The reason why the supplier would do that, because perhaps there were faulty goods, or there was an overpayment for some reason. It's basically, at the time of return, you should know what a credit note means, right? These business documents, you should be aware of them if you have exams coming up. These are the basics. What is recorded in petty cash book? All cash transactions? Not all cash transactions, only the smaller ones. Cash purchases and expenses only? No. Purchase of all small value items? Purchase of all small value items? Not necessarily. Small cash transactions, that is more specific. Purchase of all, because it can also be, well, it's not necessarily that. It can be payment for expenses too, right? So this is not very, this is very specific, and this is a bit more general, which is true. D is right. Number 7, Jacob settled the account of Ahmed, a credit supplier. Okay. He made the following entries on the credit side of his cash book. So, okay, Jacob recorded this. He paid 195 out of his bank account, and there was some discount when he paid Ahmed. Which entries did Jacob make on the debit side of Ahmed's account? Well, okay, so he will record double entry with the bank and double entry with the discount. Jacob is the one settling, so discount is received in this case. That's the confusing part. Okay, don't mess it up, please. It's not that hard. If you think, just think about it. You must first clarify the relationship. Jacob is the customer, Ahmed is the supplier. The customer is going to receive discount from a supplier, isn't it? Think about it logically. So if the customer is paying the amount, it's going to be discount received. Okay, Ahmed is our payable. When you pay something, you get a discount. You don't give discount when you pay something. The total of the debit column of a trial balance was more than the total of credit column. Okay, so debit side is bigger. The debit side is bigger than the credit side. All right, which one of these things was entered in the wrong column? Which one it can be? Well, cash. Can it be on the wrong column and make the debit side bigger? Cash goes here anyway, right? Cash goes here anyway. So if we mess it up, instead we put cash over here, it's gonna overstate the credit side, not the debit side. You see, our debit column is bigger. So it must be something that is supposed to go on the credit, but we mistakenly put it on the debit. Cash goes on debit anyway. Discount received is an income. It goes over here. Discount received normally goes over here. So this must be the one where we messed up. We must have put that on the debit side. So this is the one, if we mess this up, it's gonna overstate the debit side. This is it. Drawings go on the debit side anyway. So we cannot mess it up and have debit side greater. That would make the credit side greater if we mix this up. If we mix the irrecoverable debts up, same thing. We're in all these options, if we put them on the wrong side means the credit side, we will be increasing the credit column more than the debit, right? So this is the only option which is supposed to go on the credit, but if we mess it up, our debit will be overstated. Does that make sense? It's the odd one out, guys. It's the odd one out. All these are normally debited. This is the one normally credited, but if we mistakenly debit it, or if we mistakenly put it in the wrong column, which is the question, what will happen? Debit side will become greater than the credit. Number 9. Davy prepared the following journal entry to correct an error. Okay, so there was some error made, and this is what we used to correct it. So Samir was debited, Samuel was credited. Let's see. Cash paid to Samir had been credited to Samuel. Wait, let me read that again. Cash paid to Samir had been credited to Samuel. You know, in that case, Samuel has nothing to do with it. Cash was paid to Samir. Now, to fix this mistake, what would you do? To fix this, you will debit Sam, right? You'll debit Samuel. In this case, are you debiting Samuel? You're not. When you're correcting this particular error, we're not debiting Samuel, so this is not correct. If this was right, if this were the correct answer, we would be debiting Samuel. Next one. Cash received from Samuel had been debited to Samir. Okay, now here mistakenly we have debited Samir for no good reason. Cash, it was about Samuel. We debited Samir. Now to fix that, we have to credit Samir. Are we crediting Samir in this case? We're not crediting Samir to fix that. Not an answer. Goods bought from Samir had been credited to Samuel. Again, this is about Samir, and we credited Samuel. So to fix that, wouldn't we debit Samuel? We will debit Samuel, right, to fix that. But what are we doing in this question? We're crediting Samuel. Like, we cannot make a mistake of crediting him and then again crediting him to fix that. Doesn't make sense, right? And we are just left with one option. Goods sold to Samir, okay, in that case Samir debited, had been debited to Samuel. There we go. Goods were sold to Samir. Samuel had nothing to do with it, and he was debited for no reason. So to fix this, we credit Samuel. And to put the actual entry, sales credit, Samir debit, we put a debit entry. There we go. We're done. Okay? Number 10. A suspense account was opened with a credit balance of 840. Which error caused this? What would make your suspense account credit by 840? What that basically means. So your trial balance, in your trial balance, the debit side, the credit side. What's going on? Let's first figure out. Your credit, there's a credit balance of suspense account of 840. That means the credit side is smaller that is short of 840, right? Or we can say debit side is bigger by 840. One of those, right? Either debit side is greater by 840 or credit side is smaller. One of those things. This has an extra 840. And this has an extra 840 to balance that. We put 840 there and we put it in the suspense account. So basically what's happening is our credit side is missing out on this one. So what could explain that? A check for 420 received from a customer was debited to his account. When we receive a check from customer, what we do with that is we credit the customer account. Okay. So this entry is normally supposed to be on the credit side, but instead we put it on the debit side. Actually, that makes sense. I think that could be the answer. That could be the answer. Let me read that again. A check for 420 received from a customer was debited to his account. Okay, so normally that would be credited. I have a feeling like this is a good option, but we'll look at the others as well. Discount allowed 420 was debited twice in the discount allowed account. Discount allowed 420 was debited twice in the. Okay, so that would only cause, like when we debit the discount allowed once, that is where how it's supposed to be. If you do it twice, that will only cause a difference of 420 on the debit side. Does that make sense? That will only cause a difference of 420, not 840. Here, the debit side is greater by 840, not just 420. It's greater by 840. This is not an answer. Goods costing 420, taken by the owner of the business for own use, were credited to his drawings account. You know what that would do? That would make the credit side greater. That would make the credit side greater by 840. In this case, the credit side is missing out on 840. Not an answer. Rent received 420 was credited twice in the rent receivable account. Rent received $420 was credited twice in the rent receivable. And now, of course, if it is credited again, this will only increase the credit side, not make it shorter. So that is the answer. Yeah. Make sure you pause the video, think that through, and let's move on. Number 11. A trader calculated her profit for the year at 14,800. The following errors were then discovered. The profit at this point is 14,800. The following errors are discovered. No entry has been made for $200 wages accrued. Now, when wages are accrued, they are not expensed for this period. They are expensed for the next period. Okay? And that will increase the profit because our expenses go down and profit goes up. The insurance expense included a prepayment of 90. And oh, wait a minute, sorry. Yeah. Oh, wait, sorry. No entry has been made for 200 wages accrued. Wages accrued means they're unpaid at the end. They're unpaid at the end, so they will be part of this year's expenses. We have to add them to the expenses, and when expenses increase, the profit will go down. Sorry. So no entry has been made for this 200 wages accrued means unpaid wages at the end. Well, they will be part of our expenses this year because they belong to this year. The insurance expenses included included a prepayment of $90. We paid some, and this is what will reduce the expenses. We'll remove this from this year's expenses because it belongs to the next year. It's a prepayment, and this will increase the profit. Okay, so 14,800 minus 200, 14,800 minus 200 plus 90. That's 14,690. B is the right answer. Let's move on. Jack's cashbook maybe. Jack's cashbook showed an overdrawn balance at bank of 2,600. So it's a negative balance or a credit balance in the cashbook of 2,600. Comparing the cashbook with a bank statement, it was discovered that direct debits of 200 had not yet been recorded by Jack. So these were some of the payments made directly through the bank, which was not recorded by Jack. Jack currently has negative 2,600 in his bank account. Currently, in his cash book. And this was never recorded, so we have to further subtract the 200. He then updated his cash book. What was the bank balance in Jack after Jack's updated cash book. So just subtract the 200 from the negative 2600, that's negative 2800. Make sure in your calculator you put the negative sign, right? It's negative 2600 stars. If you just put 2600 minus 200, you'll get a different answer. Negative 2800, that's the balance in Jack's cash book after correcting the error. Let's move on. Number 13. Which item or Okay. Which item is debited in the sales ledger control account? Sales ledger control account is also known as total trade receivables account. Think of it that way. And what will increase your trade receivables? How do I know increase? Because your assets, you see, total trade receivable is an asset account. Assets are debited when they increase. And what will increase your receivables? Cash discount will reduce your receivables. Contra entry will reduce your receivables and payables. Interest on overdue accounts, I think that's right. Yeah, that will increase your receivables. If you charge your customers interest on their overdue accounts, you will make some income out of that. I mean, that will increase your receivables. Leroy provided the following information for May. What was the balance on his purchase ledger control account on 1st June? They're missing years. Well, I don't know if the year is required in this question, but as I mentioned originally, this is not 100% official, so it might have some typos and some errors. Anyway, so what they want us to do is just find the purchase ledger control account balance in 1st June. Well, we have the opening balance, we have the changes, all the changes. Let's make a little PLCA, also known as total trade payables, PLCA, or total trade payables. We start with a balance. You see, it's a payable account, it's a liability account, should have a credit balance brought down, 420, balance brought down. Credit purchases. What does purchases do to your payables? Increase, 590, your purchases. Returns to credit supplier. When you return those goods, your payables will fall, 110. Okay, that is returns. Checks paid to credit customers. Oh, checks paid to credit suppliers. That will also reduce your payables, 291. Your payables go down because you made payments. Discount received, that would also reduce your payables. Interest charged by credit, that is increasing your payables. So anything that increases your payables goes to the credit. Anything that reduces your payables goes to the debit. That is a discount. That is the interest. Okay, now let's just try to balance this account. Seems like the credit side is greater. 420 plus 590 plus 5. That is 1015 each side. 1015. And then subtract 110, 291, and the 9. 605. And that's the balance on June 1, right? 605. B is the answer. Carried down, brought down on June 1st. Let's move on. Number 15. Which item should be treated as capital expenditure? The cost of building an office extension, right away, this is the answer. The annual depreciation, that's a revenue. That's not even expenditure. It's not an outflow. But if you had to put it in a category, that's a revenue expenditure, because although it's non-monetary expense, so it shouldn't really fall in that category. But if you're just talking about those four categories, definitely not capital expenditure. The cost of repairing office equipment, that's a repair cost, revenue expenditure. The purchase of a new computer for sale. Be careful. It's not an asset purchase, it's inventory. This is purchases, not an asset. This is just inventory, right? So yeah, cost of a building extension, extending a non-current asset, that is capital expenditure. Let's move on. Number 16. On the last day of the financial year, Khalid purchased office fittings, $900. This was incorrectly recorded as office expenses. I hope you can recognize this is error of, well, it's two errors at the same time. We're mixing up the category, and the amount is also wrong. Khalid does not charge depreciation in the year of purchase. What is the effect on the profit for the year? Look, this expense was not supposed to be there, so the profit is only understated by 90 because we included this as an expense which was never there. This was simply our purchase of non-current asset, 900. It had nothing to do with profit. And what we did is we put 90 as an expense. So that's all. 90 expense overstated, which will understate the profit by 90. That's all. Okay? Logical. Think about it. It's nothing besides that. That's all. Number 17. Aggie, I think I'm saying it right, is a trader. She uses the following methods of depreciation for different types of non-current assets. Straight line at 20% per annum, reducing balance at 25% per annum, and revaluation. She uses all of them for each of her some of her non-current assets. Okay, let's see. On 1st January year 1, Aggie purchased small items of equipment costing a total of 2,400 and fittings costing 8,000. Small items of equipment, okay. And on 31st December year 2, I believe they're talking about, let's say if this is the first year of trading, that's the second year of trading, I assume. Aggie estimated that equipment was worth 70% of its original cost. The statement of financial position showed the net book value of the equipment at 1680 and fittings at 4800. Wow. Which depreciation method has Aggie used? Whoa. Okay, that's an interesting question. I think this must be a struggle for a lot of students. So let's read that again. The statement of financial position showed the net book value of equipment at 1680 of equipment, and it says it is 70% of its original. So this 1680 is 70% of original. Original is always 100%. Divide by 70 times 100. That will give us the original value of equipment. 1680 divided by 70 times 100. 2400. That's the original equipment purchase. 2400. Okay, that's one thing. And look, it's definitely, equipment is definitely not straight line. Why is that? Why is that the case? And actually, they've told us 24. It's definitely not straight line because that would just simply be 40%. Straight line is, same percentage every year, 20% the first year, another 20% the second year, total 40% will be reduced. It won't be worth 70% of its value, which means 30% went down, right? So it is not straight line. Equipment is not straight line. The only possibility is it can be reducing balance or it can be revaluation. Let's test reducing balance. So if 2400, the first year depreciation would be, well, 25%. 2400 times 25%, 600. And then the next year it's going to be 1800 times 25%, 450 for the next year. What is the net book value? 1800, sorry, 1800 minus 450, 1350. And the SOFP showed the net book value 1680, and that's definitely not the same. So it's not reducing balance as well. Equipment is neither reducing balance nor straight line. It's definitely revaluation. Now, what about the fittings? The fittings, okay. The first year we purchased, it was 8,000, and they're worth, at the end they're worth 4,800. So let's see, 8,000 times 20%. Let's try the straight line, or let's just simply take 40% because it's going to be 20% each year. 3,200 is the depreciation charge on the fittings based on straight line. We are testing straight line. 8,000 minus 3,200, 4,800. And that works. Is that correct? So it is straight line for the fittings. Does that make sense to you? Please go through that again. It's actually not that hard. It seems a bit challenging but in the beginning, but it's not, right? So they have given us the original costs and they have given us the closing balances. What you can do is you can test these methods, okay, and see if they add up. Like calculate 2 years depreciation on this based on straight line, see if that works. Does that give you 4,800 net book value? If it does, then that is correct for the oh sorry 1684. Like, calculate straight line and reducing balance on this one. See if that gives you 1680. If it doesn't, this means it was revaluation. Do the same with the fittings. Take 8,000, attempt this for 2 years, see which one adds up. Well, this one does. So straight line for the second one, revaluation for the first one for the equipment. Let's move on. Number 18. ABO prepares financial statements to 31st December each year. ABO bought machinery for 40,000 on 1st January year 1. He charges depreciation on machinery at 20% per annum using the reducing balance method. Depreciation is charged in the year of purchase but not in the year of disposal. Okay. On 1st January year 3, the third year, it was sold. So we are only taking the depreciation for the year 1 and the year 2. Is that correct, everybody? Yes, I hope so. That is correct. You understand that point. There is no depreciation in the year of disposal. Year 3 is the year of disposal. Year 1 and year 2 will be depreciated. So 40,000 times 20%. What is the depreciation for the first year? 8,000. Then 32,000, that is 40,000 minus 8,000. 32,000 times 20%. What is the depreciation for the second year? 32,000 times 20%, 6,400. That is year 1. That is year 2. Total depreciation so far, 8,000 plus 6,400. The total depreciation is 14,400. The cost is 40,000 minus the total depreciation, right? Cost, accumulated depreciation for the 2 years. My goal is to find the net book value. 25,600. That is the net book value. How much did we sell it for? 22,000. Our net book value is higher than what we sold it for. So it's a loss on disposal. Of how much? It's 3,600. We can see that clearly. Basically 25,600 minus 22,000, that's 3,600. That is the loss on disposal, and loss is recorded as an expense in the income statement on the debit side. So there we go. D is the right answer. Okay. These questions are a bit difficult, honestly. The rest of the 22 new papers, I really hope that everybody gets to see this before they go to the exam, or at least practice this before they go to their exams. Why would a business record the amount owing to credit customer as an irrecoverable debt? The customer has gone out of business. It's a possibility. The customer has liquidity problems. This is unlikely, because if they have some liquidity problems, we don't just forgive their debt. We try to still be persistent with demanding the payment. The customer is making a loss. No, we don't really we don't suffer the loss just because they are making a loss. The customer is not satisfied with the goods. No, we don't forgive their debts just because these are the reasons. We may forgive or we may forget their debts if they're out of business. There is no business they have. So where would we go for the amounts? Who will give us the amounts? There is no business. Number 20. Anji maintains a provision for doubtful debts at 5% of the trade receivables at the end of each financial year. At the start of the financial year, the trade receivables were 2,000. At the end of the financial year, the trade receivables are 4,500. Which entry would be made in the income statement for the financial year? Well, okay. So what are the provision for doubtful debts? Provision for doubtful debts in the beginning. Let's see. 100. What is the provision for doubtful debts at the end of the year, at the end of the financial year? 4,500 times 5%, 225. And remember, provision for doubtful debts, only the change is entered as an income or expense. In this case, it increased by 125, and that is only the expense. That's it. 125 is an expense. We're done. Number 21. Which business do not prepare a trading account section in the income statement? Service businesses. Furniture store, they trade. Insurance company, they are a service business. Newsagent, service business. Toy shop, trading business. Uh, Window cleaner is a service business too. So where did we went wrong? We don't have three choices. Newsagent. Newsagent is would be also be a. Oh wait, do they mean newspaper? Perhaps. Okay, it's definitely these two, 100%. 2 and 5, that's 100% sure. 2 and 5. We can go for the best option here, which is B, but that this could possibly be a typo as well. News agent, or perhaps the news agent won't make income statement at all. That's also possible. It's an individual, I guess. I don't know. Like this could be an error, but we'll just go for the best option available, 2 and 5. Although this looks like if it's a business, then it's just a service. They won't be. If it's a newspaper agent, that's a different thing. But anyway, our best options are 2 and 5. Let's just go for those. Because if we try to use 3, it goes with 4, which is definitely not the answer. It goes with 5, but then we miss out on the 2, which we know for sure is the answer. So this is the best option available. We'll go for that. Number 22. A business provided the following information. What was the capital of the business? How do you find capital? Do you remember that accounting equation? Assets equal capital plus liabilities. In this case, we have the assets and liabilities and we're looking for capital. Let's just move that on the other side. Asset minus liabilities equal capital, just based on your accounting equation. So simply do assets, 25,000, plus 18,000, minus 12,000, minus 21,000. 10,000 is your capital, that's all. So added this, subtract this, add this, subtract this. Okay, add all the assets, subtract the liabilities, just like this. Number 23, a trader bought a machine for use in business. He paid part of the cost in cash and agreed to pay the remaining part in 15 months' time. Okay, in addition to non-current assets, which items in the statement of financial position will increase as a result of this transaction? Okay, our current assets are going down because we paid some of the money. It's not going up, it's not increasing. Current assets not increasing. Current liabilities are not increasing because it's 15 months time. We have more than a year. And then another current liabilities. Look, this is 100% an error, right? One of them is non-current liability, right? One of them. It's got to be non-current liability. So if let's say that is current liabilities and let's say that is non-current liabilities, what I can tell you is your non-current liabilities are going up, your current assets are going up. So it's going to be tick with this, and not with this one. All right? Non-current assets, non-current liabilities are going up because it's 15 months time, more than 12 months. Current assets are going. Wait, current. What did I say? Current assets are going down. Okay, current assets are going down, and nothing's gonna happen to your current liabilities. Okay, current assets go down, they don't increase. So no to that, and no to current liabilities as well. Only up or increase to the non-current liabilities. That's all that's happening. Hope that's clear. Current assets are going down, nothing is happening to this one, and the non-current liabilities are going up in this case. Let's move on. Number 24, what is the purpose of a partnership appropriation account? To calculate partners' salaries, that's not the purpose. To record partners' drawings, not the purpose. To show distribution of profit between the partners. And this looks good because that's what it is. That's what appropriation account does. We calculate the profit as usual, and then we adjust it, and then we find the profit that can be distributed, right? So the way it is distributed, that's what it is. 25. James is a partner in business. He made a loan to business and received a loan interest. What is the double entry in the books of partnership for the loan interest James has received? Bank account credit, interest on loan account should be debit. That is correct. James is the partner. Look, be a bit careful here, please. He received a loan interest. What for the loan James has received. Now, when in this case James has received it, the money is already gone, so bank must be credited, and interest on loan account and expense should be debited. Expense account debit, bank account credit. If the interest was due but unpaid, if the interest was still due but unpaid, so instead of bank, we would credit James' current account if it was unpaid interest. Okay? In this case, the interest is just paid, so bank account credit and loan interest on loan account debit. Number 26. A limited company whose capital consisted of ordinary shares ceased trading and was not able to pay its debts. Okay. Which statement is correct? Shareholders would have to pay a proportion of debt based on the number of shares owned. What do you think? Definitely not, because it's a business where you have limited liability. That means you lose the money you invested, but you don't have to pay anything if the company went bankrupt. Shareholders would have to pay a proportion of debt based on value. No, no, no. They don't have to pay anything. They've lost the money they've invested, nothing more, right? Shareholders would have to sell their personal. No, 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 no. That's these all three options are against that point where we know that it's not it's a limited liability, you know, company. So shareholders would lose the money that was paid when the shares were first purchased. Exactly, because it's a limited liability company. You know, we lose only the amount of money invested. It's not unlimited liability where your personal assets are on the line. I'm stumbling upon my words because I am a little tired while recording this video. So apologies for that if my words are a bit, if there is this stammering in between. Question number 27. A limited company was formed on 1st June 2021. On that date, the company issued 500,000 $1 shares. Shareholders were asked to pay 60% of the cost immediately, with the remainder being payable on or by 1st June 2022. By 1st August 2021, all shareholders had paid what was due at that date. Okay, so that's the 60% of the 500,000, right? And so called up capital at this, wait, issued capital is 500,000. Called up capital is 60%, and the paid up is also in this case 60% because it was all paid. The remaining will be called up later on from 1st June. So on 1st August 2021, 60% was called up and 60% was paid up, right? Number 28. There are 120 members of a sports club. The annual subscription is $60. At the beginning of the year, no members were paid in advance and no members had subscriptions outstanding. At the end of the year, 7 members had not paid and 3 members had paid in advance. Which amount was shown for subscription in the income and expenditure account? Look, in the income and expenditure account, we follow the matching principle that tells us whatever belongs for that period is going to be recorded there. Something prepaid, something accrued, doesn't matter. The thing is, what belongs to this current year, which is 120 members paying $60 each, this is supposed to happen. This is what belongs to the current year. And that will be recorded. 120 times 60, 7,200. C is the right answer. What is shown in a manufacturing account? Cost of materials consumed, purchases of finished goods? Definitely not. We're producing something, we're manufacturing something in a manufacturing account. There's nothing to do with finished goods. Cost of material, yes, that is true. That's part of prime cost, direct material. Cost of production, that is part of manufacturing. That's what we calculate in manufacturing. Cost of sales, no, that's part of income statement. 1 and 3 only. Let's move on. 30. Tariq produced a statement of affairs at 31st December year 1 and 31st December year 2. During year 2, his long-term loan increased by 3,000. Whatever it was in the first year, it went, now it's more by 3,000. It's greater by 3,000. His net current assets, which is current assets minus current liabilities, it also went down by 1,000. And that means during the year, his liabilities increased by 1,000 as compared to the assets during the year. That's what happened. Depreciation for the year was 500, and his non-current assets also fell in value by 500. So you really gotta think about that a bit deeply, right? So this is based on the accounting equation. How do you find capital? Capital equals asset minus liabilities, isn't it? So in the second year, as compared to the first year, because we're just looking at the difference, as compared to the first year, in this year, liabilities are now greater by 3,000. So essentially, like that's going to have a negative effect because it's subtracted. Liabilities will reduce the capital, isn't it? Assets minus liabilities, and that's the subtracting of it. The more liabilities will be the lower capital if you look at that equation. So your capital goes down by 3,000 because of that. Net current assets decrease by 1,000, and then we also have the current liability trumping over the current assets by 1,000. So that will again have 1,000 of negative effect. Assets minus liabilities. Liabilities again win. It's subtraction is greater than the addition, isn't it? Like the overall change in the current assets is 1,000, and so that will also be subtracted. And depreciation, which is basically the fall in the value of the assets, also by 500. So it further goes down by 500. So this side, the lower it is, the lower the capital. Well, when the liabilities are high and high, this side will get lower and lower because the liabilities are being subtracted here. Think about it deeply, please. That gives us 4,500 subtracted. This was a pretty interesting question, a difficult one. When you come across something like that, don't be discouraged in the exam. Attempt the ones you can, circle this one, give your best choice, give it a shot, remove the ones that don't make sense to you, and come back to this when you have time at the end. Don't waste too much of your time on a question like that. Okay? I know it's hard to understand, but think about it. Keep thinking about it. You'll get the point. Number 31. Wayne provided the following information: revenue, opening inventory, purchases, closing inventory, gross profit. What was Wayne's gross profit margin? Gross profit margin is just gross profit as a percentage of sales. See, look at the contrast. They ask you such a difficult question for 1 mark, then they ask you this for 1 mark. Do you know? Do you realize? So that's why you must skip the ones that are too difficult and get the marks where you can quickly. And then, of course, come back to those harder ones. Okay, 2,900 over 12,800 times 100. 22.66. 22.66. Okay. Let's move on. Number 32, a trader provided the following information for the year ended 31st December. His trade payables at that date were 8,000, the closing date, isn't it? They're talking about 31st December. Total cash and credit purchases for goods for resale, cash purchases of goods for resale, credit purchases of non-current assets. What's the question? I think it's the trade payables period, right? That's what it is. Well, first of all, identify the credit purchases. What are the credit purchases? Well, this is the total of credit and cash, and this is just the cash. So remove 17,000. 150,000 minus 17,000. That's 133,000. What is that? That is your credit purchases. Found your credit purchases. How do you find trade payables period? You put your trade payables over credit purchases times 365, because we need answer in days. 8,000 over 133,000 times 365. 21.9, 21.95 days. That basically rounds up to 22 days. Let's move on. Number 33, a trader decided to reduce her level of inventory in order to reduce the storage cost. Fair enough. Sales quantity and selling price were not affected. Okay. How did this affect the profit for the year and the rate of inventory turnover? Perhaps she advertised more, but somehow she reduced it without affecting the price. And that's going to increase the profit, the total profit for the year. What about the rate of inventory turnover? Goods are moving faster, and so it's going to increase because goods are moving around, like they're being sold now. Because if you think about the ratio, it's cost of sale over average inventory, and her average inventory is going down, and cost of sale is constant. It's not moving. It's going, the denominator is going down, and so the overall answer is gonna increase, right? You can think about that. Number 34. Azim and Bashir are both sole traders. They provided the following information. What was Azim's return on capital employed? Profit for the year ended 31st December before interest. That's for Azim. Long-term loan. There's no long-term loan with Azim. So what was Azim's return on capital employed? Double of Bashir, half of Bashir. Let's just find it first. 17,200 over capital employed, which is 86,000. 17,200 divided by 86,000 times 100. That is 20% for Azim. For Bashir, it is 15,000 over 12,500 plus 25, because that's how you calculate capital employed. Capital employed is sum of these two. 15,000 over 12,500 plus 25,000. That's 40%. Okay, so it's half of Bashir's. Let's move on. Last question. Stephanie's major competitor has invested in a new machine for making goods more cheaply. Stephanie knows this will affect her sales but did not record this in her accounting records. That's money measurement. We cannot measure the effect of that competition in terms of money, right? Unless we make the loss, we cannot really just take that competition. The fact that there's a competitor, it cannot be recorded in monetary terms. We just know that we're gonna make a loss. We don't know how much precisely, right? It can be too high, it can be too low, it can be none. We never know. It's money measurement. Okay, this had a few difficult questions, but how many? 4, 5 difficult questions? Do you think you should let the remaining 30 to 31 marks get affected because of those? No, you shouldn't. When you see a very difficult question, try your best, spend a couple minutes, circle the question, move on, come back to it when you're done with the rest of the easier ones, because all of them are worth 1 mark. Have a good strategy in your exams, and good luck with it. Yeah, good night.